Hi, this is Matthew Cratter from Trader University, and today I want to talk about how to pick stocks like Warren Buffett. If you're a fan of Warren Buffett, want to learn more about him, if you're interested in hearing what sort of value stocks or deals are available in the current bear market, or just want to see how I'm trading it, be sure to hit that subscribe button. So obviously Warren Buffett is one of the great investors of all time, so I wanted to give you an idea of various things he looks for when looking at a stock. I've been getting lots of questions from people. Should I buy this stock? Should I buy that stock? I don't offer personalized investment advice. And there's another reason I don't do it, because if I tell you to buy a stock, or tell you that I like a stock, and you buy it and it starts to go down, you're not really going to have the conviction to hold it. And this is why quote unquote hot stock tips don't really work. It's much better to learn how to pick stocks yourself. And one way to do that is by studying the greats. So as I always say, I much rather teach you how to fish than just give you a fish one time. So the first thing Buffett looks for are businesses that are going to be around in 20 years. It doesn't matter how cheap a business is, if it's going to go bankrupt, if it makes a product like buggy whips, horse carriages, or something like the typewriter. This is an article from 1995 about Smith Corona filing for bankruptcy. Right before Smith Corona filed for bankruptcy, the stock got very cheap. It traded at a very low PE, and it was undervalued. But it was undervalued, or it appeared to be undervalued, because it was on its way to zero. It was on its way to bankruptcy. So it's very important to think about, before you buy a business, don't just buy it because it has a low PE. But you want to have, especially for, and we're talking about long-term investments here. Obviously, trading short-term trading strategies is another issue, and you can see my various other YouTube videos on that. But we're talking about holding stocks for the long term, like Warren Buffett does. And so you definitely don't want to buy a stock that's cheap on its way to going out of business. And so people keep asking me, for example, about Carnival Cruise, the cruise lines. This is something that you'll have to decide for yourself. Will cruise lines come back to where they were before this virus, or have they somehow been permanently impaired? And obviously, some people will continue to take cruises, but maybe 30% of those people who used to take cruises will say, no, thank you, not in my lifetime. And so cruises will be this sort of underperformer for the coming generation that lived through coronavirus. So again, that's something you have to decide for yourself. If you're going to invest in cruise lines, you need to understand the business and have an idea. Is it going to come back to levels where it was before? Now, to talk a little bit more about PEs, sometimes people think Buffett is just worried about the PEs. Blockbuster, many of you might not even remember what this was, but this was a store, a series of stores where you could go check out DVDs and video cassettes to watch movies. Right before they filed for bankruptcy in 2010, they were trading at a PE of roughly 2. So it doesn't do you any good if something has low PE if it's going out of business. And so I remember in 2010, there were lots of people saying, well, Blockbuster is trading at a PE of 2. Netflix is trading at a PE of 25. That's so expensive. Well, what was about to happen is Netflix earnings were about to skyrocket. Everyone obviously preferred to have their DVDs mailed in the mail rather than having to go to the store to pick them up at Blockbuster. And then ultimately, as we all know, Netflix went to the streaming model, and this made it very valuable. Blockbuster completely filed for bankruptcy. I think there's maybe one Blockbuster store left somewhere in Oregon or Washington, if I remember correctly. But this is another example of a low PE stock, like a typewriter stock, that was trading at a very low valuation for a reason, because it was going out of business. And so Buffett doesn't normally like to overpay for stocks. He usually doesn't pay more than like a 20 PE or so. But it's important when looking at PEs. The PE is just the P is just the price, the E is just the earnings. And what can happen is, if you're expecting the earnings to go up a lot, that will ultimately increase the denominator here, and the PE will go down, or the price as well could go up. So when you hear people say that something like Netflix is in a bubble, or some other company is in a bubble, you have to think about what its normalized earnings are, what its average earnings are going to be going forward, and also what its earnings are going to look like in, say, 5 or 10 years from now. So, for example, Buffett bought Coke at a fairly high PE. I think he paid something like 17 or 18, which was a much higher PE back in the 80s when interest rates were higher. And everyone was wondering why he paid such a high price for Coke. but it was because Coke had only begun to expand internationally. It was mainly in Europe and North America. Buffett saw that it was going to be worldwide, and so he knew that the earnings could only go one direction. So you have to be very careful when thinking about PEs, and you want to think about normalized PEs. Where is the earnings going to be in 5 or 10 years from now? And obviously, if you have something like a Blockbuster, the earnings are going to be zero because it's going to be out of business. Now, the key concept that Buffett uses is the idea of an investment moat, or a moat. You may have heard this. And this is really just a picturesque or metaphorical way of saying that a company has a sustainable competitive advantage. And you can think of it as the water or the sort of the hole filled with water that surrounds a medieval castle and protects it from invaders who in this case are competitors, competitive businesses. And so if you have a business that's very easy to compete against, what will happen is margins will be driven very low, like in a commodity business, for example. And we'll talk a little bit about commodity businesses versus branded businesses in a minute. But there are a number of investment moats that one can talk about, or competitive advantages. Again, there's that word sustainable, competitive advantage. We want this competitive advantage to not just be present this year, but to be present in the coming years. So it doesn't do you any good if you can only compete for 1 year and then you lose your competitive advantage. So what are different kinds of investment moats that we might look at and that Buffett is interested in? Having a strong brand is one thing. I like to think of a strong brand as something that appeals, in its most general sense, it'd be something that appeals from everyone, from little kids to really senior citizens. And so, for example, when my kids were really little, when they were 2 years old, they could all recognize these brands: Apple, McDonald's, Starbucks, and Disney. That's a really strong brand that's used by toddlers and also used by people in their 60s, 70s, and 80s. So a strong brand really helps. And it is a sign of, for example, there used to be this saying that you never get fired for buying from IBM. And so this works at sort of the corporate level as well. If you, or let's say you work for a school district, if you buy a bunch of Apple computers for the school district and something goes wrong with them, you probably won't get too blamed for it too badly. But if you buy some unknown computer and it has problems, then you can't just say, well, it was an Apple and I did the best that I could. So a strong brand is very good, brand recognition. And a lot of brands have been built up. There is a sustainable competitive advantage because if, for example, I wanted to go up against McDonald's has been around since the 50s or 60s, whenever it was. They spent a lot of money in advertising, just like Coke and Apple have. And so it'd be very difficult to create a brand like that. It's really kind of an American icon. And if I start a new burger store, even something like Shake Shack or something, it's beginning to develop a brand, but it's nothing like McDonald's in terms of name recognition. So that would be the first kind of investment mode, a strong brand. Next one would be network effects. And the easiest way to think about a network effect, or the simplest version, is a marketplace. So something like eBay or Amazon, as in terms of Amazon as a company that sells things. On eBay, why do you sell things on eBay? Or why do people used to sell things on eBay? Well, because that's where all the buyers were. And why did buyers go to eBay? Because that's where all the sellers were. So this is a network effect. And as people join a network, it becomes more powerful. So for example, Facebook is a great example of a company that has benefited from network effects. They started off at colleges like Harvard, and then they expanded to the general population. Now, Facebook's code, it'd be fairly easy to start my own Facebook. I could hire an experienced programmer, and I could create basically something that looked very much like Facebook and function like Facebook, but no one would use it. And why is that? Well, it's because everyone and their grandparents and their kids are on Facebook, at least kids above a certain generation. And this would apply obviously to TikTok or Instagram as well. And so Facebook has that advantage, and as a result, it really is the leader among social network companies. It's very hard to assault. Now, things like YouTube have their own advantages, and Twitter have their own effects as well. But once a company has a strong network effect, like Amazon, for example, you always go to Amazon because they have the biggest selection, And why do sellers go to Amazon? Well, because they have the most buyers. So that would be an example of network effect. And as I've spoken about in other videos, Bitcoin is a great example of something like this that has both a brand and has very strong network effects. In fact, 7 network effects, according to Trace Mayer. Now, the third type of investment mode, and obviously a company can have multiple types of investment modes, would be scale. So Walmart is sort of the classic example of this. They grew very fast, they grew very big, and when you're a very big company, you can get discounts and you can get sort of bulk prices when you're buying things. And that's why Walmart can buy, for example, toilet paper in bulk and then offer it, because they're paying less for the toilet paper, they can sell it for less and undercut all their competitors. And so big grocery stores like Walmart or Amazon have this huge scale. And with scale comes the ability to purchase at scale and pass on the savings to your customers. Another example would be of a moat would just be the fact that you're already a big company. And this is especially important right now when we're all shut down due to coronavirus. Your local coffee shop, it's questionable whether it'll be able to survive. It doesn't have financing, also doesn't have that strong brand. It may have a strong local brand, but Starbucks, just to use an example, has access to capital markets. They can go borrow money by selling debt, by raising debt through selling bonds at a much cheaper price. Your local coffee shop is not going to, they could try to go to a bank to get a loan right now. The bank's probably overwhelmed with lots of other stuff. But Starbucks can tap the capital markets. They can sell more stock, they can sell more bonds, and they can raise money to get them through this difficult period. And they can also, even during normal times, Starbucks can borrow at a much lower rate of interest than you or me or a local coffee shop. And so this is one reason why the big get bigger and it becomes very hard to compete against them. Even if your local coffee shop probably has much better tasting coffee than Starbucks, but ultimately it doesn't matter. And this is what an investment moat is. Another investment moat would just be simply location. There are only so many locations in the physical world. If you've secured some good locations for your flagship stores or your stores in general, you can think of Apple Store always having these amazing locations. Starbucks, you'll have one on the corner of every major street and even one across the street. Chipotle, McDonald's. McDonald's has done really well, mainly as a real estate company because it has such great locations as well. And Starbucks, because it has access to the capital markets, for example, can afford to pay more for rent than your local coffee shop, so they can outbid the local coffee shop and have a better location. Better location will lead to more foot traffic, higher sales, and higher profits. And it becomes a self-fulfilling prophecy, really. Another example of an investment moat, intellectual property, patent. If you have a patent to make a certain kind of drug, you can really coin money until the patent expires or until generic competition is allowed. So intellectual property would be a great example of this. It often doesn't last forever. It can be stolen. It can be reproduced. But this would be an example of something that gives a company, if not a permanent investment moat, at least a head start and an advantage. And really, you can pair with that innovation. So just think of Apple under Steve Jobs, for example. He was a one-man investment moat, and he could just come out with these amazing ideas. And there was no one like him at Compaq or at Microsoft, for example, coming out with just incredible products like the iPod and iPad and iPhone, etc. So human creativity, having a charismatic founder, having a brilliant idea guy, someone like Elon Musk, for example, that would be an example of an investment moat, because you can't clone Elon Musk, you can't clone Steve Jobs. And then another, there are more investment moats than this, but we'll stop here for now, would be eligibility for government bailouts. And this is sort of a cynical one that Buffett doesn't talk about explicitly, but we do know that he invests in banks, he invests in airlines. Another example of a kind of company that would be eligible for a bailout would be the defense companies. If you have someone building your country's weapons, you have a very good incentive for them not to go out of business. and to preserve the equity stakes. Now, obviously, companies can file for bankruptcy, they can be reorganized and still build weapons. But in practice, what happens is that there are bailouts for the shareholders. And Warren Buffett has benefited from many of these bailouts. For example, during the Great Financial Crisis, all of his bank companies, like Wells Fargo, Bank of America, got government bailouts. Your local coffee shop, Congress pretends they're going to bail you out and give you some sort of payroll protection or forgivable loans. But in practice, what happens is that the big companies still take advantage and get bailouts. So a good example of this is, just saw this in the Wall Street Journal, a lot of big restaurants and hotel chains will also get small business loans. And so they'll be competing against smaller businesses. And the example they give here is Shake Shack, which is, has $500 million in annual revenue. I guess there's some loophole that enables them to also collect benefit from this small business loan program, where I think the loans are ultimately forgivable. And so inadvertently or advertently, Congress is helping to prop up Shake Shack at the expense of your local burger restaurant. Okay, so those are the investment moats, really brand, network effects, all the way through government bailouts. Now, when we think about the kind of companies we want to invest in, especially if we're thinking like Warren Buffett, we want to avoid commodity companies. And I mean that in its most general sense. And a lot of this has to do with having a strong brand. So for example, when you buy paper clips, you probably do not know who makes them. Maybe you buy the Office Depot brand or whatever, but you don't really care when you're buying paper clips or staples or even pencils. You probably don't even pay attention to what they're made. So these are commodity products. And the companies that make them have very low margins. Margin is just how many pennies or cents you make per dollar of sales. And when something is a commodity, like corn, for example, it trades at a commodity price, and there's just razor thin profit margins. And so Buffett tries not to invest. He tries not to invest in these commodity-like businesses where the consumer doesn't really care whether they're getting a staple or a paperclip made by X, Y, or Z company. And that's what makes companies like Coca-Cola so valuable, because they have this very strong brand. And if you're at the grocery store and you have a choice between buying Coke, let's say you're not buying it for yourself, but you're bringing it to a party, and let's assume times aren't really rough, are you going to bring fresh cola drink that looks like this to the party? You'll look sort of, obviously if this is the only thing you can afford, that's one thing, but you might look sort of cheap. It might not taste as good. There's some uncertainty here. Is this going to be, I'm going to save 20 cents on a 6-pack, but is it really worth it when I can get the real thing? And Coke, obviously, people recognize the brand. If you bring a 6-pack of Coke to a party, no one's going to say, what is that? Now, obviously, tastes change. There is, Coke has ultimately been associated with sugar and diabetes and all these things. There's obviously Coke without sugar, but this is something, for example, if you're going to buy Coke, when Buffett bought Coke in the late 80s, everyone was still drinking soda and these sort of really sugary beverages. And so that's one thing you have to ask yourself. If you look at Coke's revenues, they've been sort of stagnant for the last few years. Is this just a temporary thing, or is it a long-term change in consumer preferences? Is Coke going to go the way of the typewriter? And I can say in terms of what I drink, I used to drink a lot of Coke, and now I drink sort of more specialized beverages. And that may just be me and the certain group I'm in, but it may be a more general thing as well. So you have to, again, when you're buying a company for a long term, you have to think about its long-term business prospects. Obviously, if you're just trading Coke stock or buying it to hold for a single dividend payment, that's another thing. But we should not assume that a brand that has been good in the past, for example, General Electric was a brand that was very, it's the kind of money that you could tell your grandkids or your grandparents to put money in, and then it sort of lost its luster because of various financial stumblings and possibly fraud as well. So something to think about with companies like Coke. They may have been around for a while, but you have to really decide for yourself: has anything changed, or is the brand going to sort of lose its luster? So let's I wanted to look at a couple companies. I know a lot of you have asked me about Starbucks. Starbucks is interesting because they're basically a drug dealer company. I like Starbucks. I like coffee. They sell an addictive substance that happens to be legal. And they've got a very strong brand. My kids love getting steamed milks there, for example. And this is a brand that it's got good presence. Everyone recognizes it. People who are 2 years old drink Starbucks coffee and beverages. People who are 82 years old also drink it. So it's an interesting company to look at. Also, as we said, they have access to the capital markets, to cheap financing, etc. And in a crisis like this, what would we expect to happen? We would expect a bunch of local mom and pop coffee shops, unfortunately, to go out of business. And those are the ones I always try to go to. I enjoy them a lot more than corporate sort of fake culture like Starbucks has. But Starbucks is they've got drive-thrus, they're very convenient as well. So one thing we would expect during this coronavirus scare and financial crisis is that Starbucks and Peet's and some of these other big coffee companies would gain market share. Because they already have the strong brand, they have the staying power, maybe they can even access some of the current loan programs. So one thing you can do is you can just go to Google, type in Morningstar Starbucks or SBUX. That happens to be the ticker. That'll take you to this page on Morningstar, and this is all free. Most of the stuff on here is free. So what do we see on here? Well, we see that it currently has a market cap of 82 billion. So this is a big company. That's just the value, the number of shares, total shares outstanding times the stock price. That gives you the market cap. Gives you an idea of how quote unquote big the company is. Companies like Apple and Amazon have market caps over $1 trillion, but this is still a very big company. Currently trading for $71.58 a share. And then one thing I always look at, what is its forward dividend yield? And this is what you would expect to make if you hold the stock for the next 12 months or so. You would get paid this sort of yield, assuming there are no dividend cuts or anything like that. So that tells you. So now what we can do is if we click on, let me see here. Yeah, if you basically click right here on financials, it'll take you to the next page. So what do we look at if we want to look at a company very briefly? We've already determined Starbucks has a good investment moat. It's got a series of moats, including brand, access to capital markets. We expect it to grow market share over the coming months as smaller coffee shops shut down. Now, what do the financials look like? I'm not going to go too deep into this, but I want to show you some of the things I look for. You want to see revenue growth. Revenue is just sales. And so here they have 3-year annualized growth. We can see that they've been growing their revenues at 7.5%, and they've been growing their net income at 8.5% over the last 3 years. So this is a company, basically, if you're not growing revenues, your company is stagnating, and there's something wrong. Simply because even if you're not really growing your revenues because of inflation, the price of a cup of coffee at Starbucks will always go up over time. And so you want to see revenues increasing at single digit or even double digit. Return on assets is another important metric. Basically, what sort of investment return can they generate on their tangible and intangible assets? Also, return on equity is important. I believe Starbucks has negative book value, so there's no real value for this. But very important to see growing revenue, good return on assets. And to give you an example of a company that is well known that does not have this, we'll talk about GameStop. And if we look at the same page for GameStop, we can see that their revenue has shrunk by 6-7% over the last 3 years. They have no net income. Return on assets is negative. Return on equity is negative. And if we scroll down a little bit here, they have some sort of the highlights from the income statement. We can see that revenues, these are expressed in billions, have declined every year since 2018. Net income or profits has gone from just slightly above zero to negative, so the company's now losing a lot of money, etc. And so this is what you don't want to see. If we scroll down and look at Starbucks in the same place, we'll see that revenues have been marching up since 2017 from 22 billion to 24 billion to 26 billion. Now, obviously, in 2020, I imagine a lot of Starbucks stores are closed or people aren't going to them worldwide because of the virus. And so we'd expect revenues to fall for this year. But if you're buying something for the long term, you don't really care about a 1 year drop. Presumably, people go back to drinking at Starbucks. Maybe some people learn that they enjoy making coffee at home more, but especially when they get busy and go back to work, they'll probably still be buying some coffee from Starbucks. And so when you're valuing a company that you're going to hold for the long term, you want to think about normalized revenues, normalized net income. What is it going to look like in an average, normal operating environment? Now, hopefully we're not in lockdown for the next 5 or 10 years. That would obviously change something if we just get wave of virus after virus and mutation after mutation. I don't think that happens. And so you at least want to see that a company is growing their revenues during normal years like 2017, 18, and 19. As we said, they've been growing net income since then. It looks like net income moved down slightly. 2018 was a peak, moved down a bit in 2019, but still the 3-year trend is up. Now you can also, if you really want to dig into a company, you want to download their 10K, you can just Google Starbucks 10K and really read about where these revenues come from, etc. I use Starbucks as an example because we have a good idea, basically how they, what they sell and how they make money. Down here, so net income is just the total in billions. Then we have diluted earnings per share. We can see that's marching up as well. We also see it peaked in 2018, coming back down. But then the last 12 months, it's been bit trending back up again as well. Balance sheet, we can talk about this. You can talk about this some other time. Cash flow statement. I think that's basically all we want to see on here. But you want to see that at a very high level, you want to make sure the business is going to be around, that it has an investment mode, that they're steadily growing revenues, that they're steadily growing net income. This is very important. And as we saw with GameStop, this is a company that's shrinking, that's dying. People don't want to go to a store when they can just download software. I don't know much about how people purchase their video games, but I imagine that is part of the problem with GameStop. And even if we don't understand why, just the fact that their revenues are going down and they have all these physical stores they need to take care of suggests that this is not, this may go the way of the dodo or the way of Blockbuster. What do we do next? Well, let's go back to Starbucks. If we like Starbucks, we can go to Yahoo Finance. We can click on the financials here, and again, we can look at some of the same net metrics. For example, I like to look at net income, which you can also get from Morningstar. That we can see the net income for the last 12 months has been about 3.7 billion. And again, these are all, you have to be careful, look up here to see what the numbers are expressed in, all numbers in thousands. So this looks like a million number, but there are actually 3 more zeros on the end here. So this is 3.7 billion. And we can see the range of their earnings is really over the last few years, 2.8 billion up to 4.5 to 3.7 billion. So the next thing I would want to check is, what does their debt situation look like? So we've got the income statement. Let's just say that we think on a normalized basis they can make about what they made over the last 12 months. Now obviously this is going to fall in the next 12 months or so, but they'll probably get back up to it at some point. So 3.7 billion. Now let's go to the balance sheet. And this is to make sure that the company doesn't have too much leverage, too much long-term debt that will lead to it possibly going bankrupt before good times can come back. So let's see. I'm sorry, I have to go back to income statement. What did we say for the net income? Okay, 3.7 billion, and then we'll click on balance sheet. So if they generate about 3.7 billion in earnings, let's look at their long-term debt. According to the balance sheet here, you'll find it under liabilities. Long-term debt is currently at about 11 billion. So if we take 11 billion divided by 11 billion divided by 3.7, that means they could we'll just write it up here. 11 billion divided by 3.7, that means they could pay off, just eyeballing it, they could pay off all of their debt if they're generating 3.7. Now debt is paid off using free cash flow, but we're just going to use earnings here. That means they could pay off all their debt in about 3 years. So that tells us the company is probably not too levered, doesn't have too much debt. I like to see all the debt being able to be paid off in 3 to 5 years or so, or even 1 to 5 years. So that gives you an idea that the company is not too levered. A company like Carnival Corporation had so much debt, and their business went off a cliff. They needed to issue more debt, issue more shares just to stay solvent. So this was just the article again about how big companies are really going to use some of the small company benefits to stay around. So that's Starbucks. I guess the next thing one would do is you can go to the you can go back to the summary page here. So the ultimate question then is, and again on this summary page, they have the forward dividend yield here, 2.42%, and they should have the PE as well. Now, if you take the PE ratio and you just invert it, so you divide this by divide this into 1. So we'll just call it 23. 1 divided by 23, and you get about a 4.3% earnings yield. This gives you an idea of what it sort of converts the stock into a bond yield equivalent. And people, I think Buffett has even called this an equity bond. Now, 4.3% is not great, but one thing we do know is that over time, Starbucks earnings should grow, especially we're expecting them to take market share from smaller businesses. So we would expect the earnings to go up, and as a result, this earnings yield to go up. Now, how do we evaluate this? Well, the company pays a dividend yield of 2.42%, and they have an earnings yield, which is higher than that, of course, of 4.3%. So you can sort of pretend to yourself that you've got an investment here that's like a bond that's yielding a little more than 4%, and that this yield will go up over time as they grow their earnings. Now, is 4.3% a good deal or not? Well, this is where it really comes down to the individual investor. I think this is a little bit expensive for Buffett. He probably would prefer PEs under 20. But on the other hand, a high PE is okay if they're going to grow their earnings a lot. And that will mean that this PE is not as high as it appears. And so when you're evaluating this, think of the dividend yield, 2.42%. Think of the earnings yield. And then think about what you can earn on your cash or alternate investments. So if you just Google, I Googled high yield savings accounts. Most savings accounts yields right now are very close to zero, especially if you're one of the big banks. And I don't know how long this is going to last. This is Marcus, which is done by Goldman Sachs. It looks like they still are offering a yield of 1.7%. This eventually will probably get cut down to zero. But this would be a risk-free place to put your cash. It's covered by FDIC insurance up to $250,000 per account. And on the other hand, this yield it's pretty good, but it's not going to go up over time. It'll probably go down over time. So this would be one alternate use of your money. You could buy a rental property. You could invest in a tech company. You could invest in Bitcoin or gold. There are obviously lots of different things out there. But that's one way to evaluate this dividend yield on Starbucks. So for example, 2.42% dividend yield. That's obviously higher than the 1.7% that you're getting from Marcus. We're expecting this savings yield to go down. Starbucks, we would expect this dividend not to get cut unless this lockdown just extends for years and years, which I don't expect it to. So you're making a higher yield. You're also, if you take into account the earnings yield, you're ultimately making more money, assuming the company takes that difference. Basically, the difference between what's paid out and what's earned is reinvested in the company. If they do smart things with it, if they maybe open up more stores, and hopefully the world's not too saturated in Starbucks, they can earn a good return on capital on that, and you really will be compounding your money by holding the stock. The dividend yield will go up, the earnings will go up. On the other hand, if you think management are not good capital allocators, if they're going to use this excess capital to buy ice skating rinks or farms or do really crazy things with it, maybe pay themselves more. And this was a problem that Coca-Cola had in the 70s and 80s. They were buying, I believe they bought an ice skating rink and a sports team. They were just not focusing on their core business. But to the extent that management is competent, they buy back stock, they pay a dividend, they reinvest in their business, you'd expect this earnings yield to go up. And even if it doesn't, hopefully the management's not destroying too much value, and you can collect this dividend yield, especially if you're retired and you need current income, 2.42% dividend yield at current prices. Now, if that's not enough for you, maybe you need a 3% yield, then you would want to wait until the stock fill. So we can see the forward dividend right now is 1.64. That's how many dollars each share pays. And so if you want a 3% dividend yield, what you can do is just take that forward dividend divided by 3%. And if I've done this right, that should give you the target price for the stock. So let's see, 1.64 divided by 0.03. That gives you a price of 54.66 on the stock. Now we can see that it's currently trading at 71. So if you want a 3% dividend yield, maybe you wait till it gets down to 54 or 55. And this is why I can't tell you what to invest in. I can't tell you, I don't know what you want, what your goals are, your current income goals, your capital appreciation goals. And that's why it's important, and I much rather have you understand how these things work so you can decide what price is a good price. Now, maybe Starbucks never gets down to 54, 55, though it looks like in the last month it actually got down to 50. So maybe if we see new lows in the stock market, it'll get back down there again. On the other hand, it could just keep rallying from here. If you buy it here, you lock in a dividend yield of 2.42%. And so that's something to keep in mind. Are you a current income investor where you're really looking for that dividend yield? Or are you looking for a little bit more growth? It seems like Starbucks, it doesn't have the growth of a tech company, but it does have some growth. And so PE around here seems somewhat reasonable to me. But again, it will really depend on what your alternate investments options are as well. If you found this video helpful, I'd encourage you to check out my online courses, especially this course on financial statement analysis. If you really want to dig down, and as Buffett has said, financial statement analysis is really, it's the basics of business. And if you don't understand income statements, balance sheets, cash flow statements, and as well as different investment ratios, you're not going to be a good long-term investor. Obviously, the investment moat is a key idea, but you also want to be able to really dig into a 10K and read financial statements. So that would be a course to check out, as well as my bear market trading strategies if you're a little bit more into shorter term time horizons. I've got courses on trading options, more technical analysis, price action trading courses, learn to trade futures as well. So really a huge variety of courses here that cater to the fundamental investor, the Buffett-like investor, as well as momentum investors, people who are more interested in price action trading, day trading, and swing trading. Now the good news is you can get unlimited access to all of these courses just for a fixed price. If this is something that interests you, you can just click on the description notes below. I've got a link. It'll take you to this page. You can click on any of these boxes and see the actual curriculum for the courses. And if it interests you, you can click Get It Now right here. Then monthly tuition normally is $125 for 30 days access, but I want to give you a special deal for all my YouTube watchers. Basically, if you go to this page and click Have a Coupon Code, type in YT for YouTube 99, click Update, and that'll take $26 off the monthly tuition, the 30-day tuition. So you'll be paying just $99 to get access to all 12, 13 courses, including that course on financial statement analysis. And there are no long-term contracts, so you can sign up for just 1 month, watch all the courses, cancel before 30 days is up, and you won't be charged again. And you will have really learned a lot. This is for people who want to go to a deeper level and really use this time to become better investors and better traders. Hope you found this video helpful. Please hit that subscribe and like button if you did. And let me know your questions, comments in the comment section below, as well as if you have a suggestion for future videos that I should make. Thanks a lot for listening. Hope you're all staying well, staying sane, and I'll see you in the next video.